One of the first things you need to do before you start investing in anything really, whether it's real estate or any other type of investment, is figure out what your attitude is or what your mindset is towards investing. A lot of people years ago, they used to try to invest in stocks and bonds, and there was not a lot of hesitation, and I'm talking a lot of years ago, because they were comfortable with the stock market. They've heard about it, they felt it was a good place to go. It was a safe place to go because it's regulated. And so when they were there, they knew that they were being presented with an opportunity that's been, had some sort of guidelines, some sort of restrictions, some sort of controls around what they were being presented, what they were being offered, right? And then to further help with the, I guess, the risk associated with those types of investments is they came up with mutual funds, or they started offering things called mutual funds. And mutual funds were built to help people focus on their real estate investments. So they had mutual funds focused on, let's say, for example, U.S. stocks, mutual funds focused on Canadian stocks, mutual funds focused on the technology sector, focused on the energy sector. I guess that's one advantage if you're looking to get into that specific field. The other type of mutual fund that was built, or I guess that was available, are mutual funds that were offering diversification, right? So you could get a mutual fund that had a certain percentage in one sector, a certain percentage in another sector, or a certain percentage in a geographical area. Okay, so mutual funds were helping people make decisions for themselves around what type of stock they want to invest in. The other thing you need to do when looking at getting into real estate investing is how comfortable are you with an investment from a risk perspective, okay? And risk will vary depending on your age and depending on the amount of money that you have. So, for example, if you're just getting started out, if you're a younger person, maybe your risk tolerance is a lot higher. So maybe you want to invest in unknown entities, unknown stocks, unknown asset classes, right? So because if you fail in a real estate investment, maybe you have the idea or the thinking is you have a bit of time to recuperate from your losses. Whereas if you're older and you're looking for to get into if you're trying to build up a pension plan, if you're looking to invest for retirement, you may not have as much time to respond to any type of losses that you may have incurred as a result of a bad investment, which is not something you want to do anyway, right? But you also have to be prepared for losses. The other aspect of investing is how much money do you have to invest, right? So if you're, I don't want to call it a wealthier investor or somebody with a little bit more money than, let's say, someone else, I guess it really doesn't matter how much money you have, but what you want to do is you want to look at a certain percentage of money that you're going to allocate to a particular investment. So if you're looking at getting into, for example, a private equity investment, and you're not sure about it, it's your first time, and you've heard about private equity investments, you've seen some people get pretty good returns. There's quite a few offerings now. You've talked to an investor. You've talked to an investment advisor who's offering private equities, so you feel more comfortable with getting into that type of investment, right? So this is a consideration when you're looking at investing in private equities is how much money do you want to actually allocate to that type of investment. It may vary. For example, you could say, okay, I want to put 10% of my portfolio into that investment. I want to put in 20% into that investment, whatever you're comfortable putting in. So how much money you have will, I guess, determine how much money you're willing to risk. But you could use a percentage, which then will vary depending on how much money you do have. So, for example, if you're looking and you have, let's say, $1 million that you've allocated to your investment portfolio or that you've accumulated into your investment portfolio, and you could say, okay, well, now I'm interested in private equity, but I'm only going to allocate 10% of my portfolio to private equities. And that's another way of doing it to help manage your risk, to help manage your diversification. And then finally, the other aspect that you want to look at when you're investing is what time period are you looking to invest? Are you looking for a short-term investment, meaning are you looking for something where you can invest and get out in a year or two or three? Or are you looking for something that you're okay with waiting for 3, 4, 5 years? Some longer term investment. That will determine what you're looking at when you're trying to get involved into any type of investment, really. Some real estate in general, you can have some short-term investments in real estate, like a one-year mortgage, for example, if you want to invest in that. Or you could look at a private equity that only returns or that only exits after 5 years uh, with as part of that investment. Okay, so those are the things to think about when starting to invest. Get your mindset right, get your attitude right towards investing. Thanks very much.